book value and net financial obligations because I start with that. So I apply the cost to that part. That's why I'm using a different discount rate. Now it's a little bit easier because we have better estimates of uh, income from operating assets. In fact, we call them operating income. Uh, you may have estimates of earnings from analysts, but using the known stuff about operating cash and financial obligations, you can back out what's the estimated operating earnings are going to be, right? After taxes, of course. But even those, for example, let's look at the operating expenses, okay? For example, as part of that gross profit, you have cost of revenue. Part of that cost of revenue is depreciation. Is depreciation a real expense? No. So you need to correct for that. But thankfully, we can. I mean, when you do this for a living in real life, you basically create a pro forma balance sheet where, due to the nature of business, depreciation is a certain percentage of assets, right? So you can always assume that and you go from there. Plus, there are issues. For example, you see that number, research and development. Do you really think that Google is actually spending $50 billion in cash to research? No, I mean, they do spend money on research. That is not directly contributing to their sales, but it is not 50 billion or $40 billion a year. Part of that number is book the value of the so-called stock-based compensation. Google, just like many tech companies, gives stock options to their top employees, and in fact, to many employees. In the old days, you didn't have to expense them until 2006. I even remember the name of the regulation, FASB 123R. Okay, FASB is short for Financial Accounting Standards Board. They said in the old days you had the option. You either amortize that over 40 years. Let's say I gave you options that are worth $40 million. If I valued them, every year I'm going to write off $1 million. Oh, in fact, you had the option of just mentioning that in your footnotes, but you don't have to expense it at all. Certain companies chose, certain companies didn't. That kind of created a double standard. So FASB decided from now on, everybody's going to attach a value to those options, and you're going to amortize them over the vesting period. Most of these options are for 10 years, and almost invariably, vesting period is 3 years. That means within the vesting period, you cannot exercise those options. Example, Elon Musk back in 2012 were given options where the strike price was $12. This is before the stock split. And by the time 2022 came, the stock was trading at $1,000. Almost always, when these things are issued, they are at the money. That means the exercise price is exactly the same as market price that day. It's done for tax purposes. For example, if the stock's trading at $10 and I gave you a stock option that has an exercise price of 5, IRS says, let's say I gave you 1 million options like this. You just made $5 million. That's your income. Pay me taxes. But if I give you an ATM option, ATM is short for at the money, the so-called intrinsic value is 0. So you don't pay any taxes then. You pay only taxes when you exercise these options. In fact, what's his face? Elon Musk had to exercise these because if you don't exercise them within those 10 years, they expire worthless. So at the end of 10 years, he had a right to buy the stock at 12, market was 1,000. It would be stupid not to exercise them. But IRS says whether or not you actually sell those stocks that you buy at 12, IRS says you paid $12 for something that is worth 1,000. Whether or not you actually sold those stocks, you made money. So if I have 1 million options, I made $988 million as far as IRS is concerned. Given how high his tax bracket is, including states, local, and whatever, he was going to pay at least $500 million in taxes on those. He actually had to sell stock so that he could pay the taxes. He, of course, exercised them. But at the time you issue, FASB says use some commonly accepted method of valuing it. There's no one standard one, but it's typically Black-Scholes model with an assumed life is used. So I attach $3 million to these options as a value. Then I take those $3 million. Every year I'm going to write off $1 million as stock-based compensation expense. But it is not something that I actually pay. Or every quarter I'm going to write off $250,000. And you see what that number is under statement of cash flows. Cash flow from continuing operations. Right here. For Google, it was almost 23 billion. So more than close to 60% of their so-called R&D expense is actually non-cash. Okay? So you need to make an adjustment for that, just like you need to make for depreciation. For example, instead of regular earnings, I would definitely use EBITDA. EBITDA plus taxes, maybe. Why? First, or you can allocate taxes to your income from income from non-operating business. EBITDA means earnings before interest, depreciation, amortization, and taxes, right? Taxes I can put back in, so it's more like EBITDA, something like that, all right? Depreciation is a non-cash expense, so I'm going to take that out. The reason I'm going to take interest out, at least on an after-tax basis, I already take care of that on the non-operating business. Remember, value of non-operating business is simple. Book value now minus net financial obligations. Or value of non-operating business is negative net financial obligations. That's it, done. On the operating part, I need to take those out. You just do it on a after-tax basis, which we're going to handle those on Wednesday. In fact, we'll kind of build a template where you just put in the inputs, it calculates it for you. We have to kind of be creative about the terminal value stuff, but the more stuff that you can clean up, the better it is. For example, yes, we're going to take out that, but sometimes there is so-called option overhang on these companies. Think about Tesla when it was trading around $1,000, and there are all these options outstanding that Elon Musk has chosen not to exercise yet. Obviously, again, I'm making a simplification. Let's say there were 1 million options. The intrinsic value of those 1 million options themselves are almost $1 billion, right? But if you look at Tesla's book anywhere, you're not going to see any correction that is made for them. Why? Because it is not exercised. When and if he exercises it, Tesla is going to recognize that as a loss. Why? They issued shares. That's going to go to so-called comprehensive income, but They issued shares at $12 when they were worth 1,000. In fact, IRS is going to let you write off taxes based on that. I mean, even IRS recognizes that you lost money. Of course, they know they're going to get their money from the guy who exercised those options, so IRS doesn't care. All right? So you need to figure out what that option overhang is. And again, I wouldn't do it in this class. Maybe we can quickly look at it, how to do it. If we go into the footnotes of 10K statements, all that information is available. They tell you uh, on average what's the strike price of outstanding options, which one of them are exercisable, and what's the attached value of those options. If you don't know anything, you can value them yourself using a simple model, which we're going to do towards the end of the semester. We're going to create a option valuation model for those executive stock options. So the more things you can correct to get a better book value for the non-operating business, the more resilient uh, residual income model is going to be. It's like if you start working with better quality inputs, your model is going to produce better results. Surprise, surprise. So yes, accountants give us numbers, but as finance people, it is our job to make them make sense, to make any corrections. In fact, Penman calls this clean surplus accounting. What we get right now is so-called dirty surplus accounting.